News out of China over the weekend indicates that they believe they will come out of this recession earlier than most other countries and are already starting to see the light at the end of the tunnel. While several global agencies are gloomier about China's economic growth forecast, the Chinese are still targeting an 8% growth for this year. They feel the stimulus plans have already helped to increase investment in the first 2 months of this year, and bank loans have quadrupled in February. If they do come out of this earlier than expected, this would provide some welcome news for farmers and the general economy, given that China is a major export destination for our products. The Chinese have been battling to boost growth amid tumbling exports, rising unemployment, falling house prices, and the risk of higher loan defaults. Millions of migrant workers have also been forced out of work, as declining overseas orders force factories to scale back production or even shut. In market news, North American stocks were in the red or lower on Friday, while European stocks rose. Well, it's been a big few weeks for interest rate and currency markets. The New Zealand dollar has gone through a big upward swing in the past 10 days, over 6 cents in that time. It is currently sitting in the late 55-cent range to the US dollar. In the same way that the New Zealand dollar has been moving up, so too have New Zealand wholesale interest rates. Since the official cash rate announcement that largely disappointed the market, interest rates have been moving higher, especially longer-term rates. It seems that there is increasing pressure being put on these rates, as it looks more likely that this easing cycle will come to an end a bit earlier than expected. Also, the huge amount of debt that is going to be raised globally to pay for bailouts and stimulus packages is also likely to have an upward effect on rates. Governments will have to compete for investors' money and be forced to increase their offered rates. However, in a volatile environment, anything can happen, and so there is still a chance that rates may still go south if further weak news emerges. But one thing is for sure, now is the time to closely follow interest rates and look to take advantage of these lower rates to fit within your own comfort zone. International beef prices seem to be holding on despite the weakness in the US economy. While the New Zealand dollar has been trading higher over the past week, it is still well down on levels seen over the past few years, which is helping to keep local schedule prices relatively high. We are now coming into the shoulder period for the US market, and some states will be dusting off their barbies for the summer months. This typically will show some positive signs for beef prices, as there is an uptick in demand for beef patties and grinding beef. However, it would only take another cull of dairy cows or a surge from South America to put a dampener on any price increases over the next few months. With a few positives in the mix, it seems that local beef prices may hold at current levels, with the big unknown being the rising New Zealand dollar.